Well, ladies and gentlemen, my name is Greg Michalowski from GregMikeFX.com, and this is the end of day Forex report. Today's date, August 20th, 2014. I remind everybody that trading foreign exchange carries a high level of risk and may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Should you decide to trade foreign exchange, carefully consider your investment objectives, your experience level, your risk tolerance. You can lose all or part of your risk capital in the foreign exchange market, so be aware and be prepared. The winner today is the U.S. dollar. Why? Because the FOMC said that labor market conditions were getting better overall. They said that, suggested that the line in the FOMC statement that reads a range of labor market indicators suggests that there remains a significant underutilization of labor resources, probably be strucken soon out of that. They also said that the job gains might bring a rate rise sooner, and said that most of the FOMC expected continued progress toward the Fed's dual goal and that the job market noticeably closer to normal. All these are glass is more than half full now as far as the employment goes, which is something different. We'll see if Janet Yellen follows that up on Friday when she talks about employment at the Jackson Hole Symposium. And you can bet that the market will be listening to every single word to see if she's changing her stripes a little bit from her dovish comments about all the other measures of employment. She has to turn around at some point. We'll see if that Jackson Hole Symposium is the place where she does it. Anyway, the dollar was strongest against most of the against all the major currency pairs. The pound sterling was right behind that currency pair, only losing ground against the U.S. dollar. In the U.K. last night, the minutes of the Monetary Policy Committee meeting had two members suggest that rates should rise at that meeting. So that is something new, and certainly turns the bias back, not necessarily to tightening anytime soon, because 9 were against it, but it starts the process of thinking about tightening in the UK. New Zealand and the dollar versus yen were the weakest currency pairs, helped out by the US dollar strength. Mainly, especially against the dollar versus yen. New Zealand, we saw some technical selling. As far as the stock markets go, they were up mixed today, I guess. The NASDAQ composite was down fractionally, and the S&P was up fractionally as well, as was the Dow Jones, up 0.35% for the Dow Jones. In the European markets, most of them were down. As far as bond yields go, saw an uptick in U.S. bond yields from about 240 to 243. German bond yields stayed around the same, but there is some more talk about how overseas interest rates were too low. Look at the French bond yield, 1.38 for the 10-year French bond versus 243 in the U.S. Look at the Spanish bond yield, 240 versus 243 in the U.S., lower than U.S. yields. This has some people thinking that there's going to be a flow out of European markets into the U.S., and that would support selling of the euro, buying of the dollar. So we'll keep that in mind. Let's take a look at the euro versus U.S. dollar. This too, this is a daily chart, and if you go all the way back to 2012 low up to the high, we corrected or testing right now, as a matter of fact, the 38.2% retracement of that move to the upside from the 2012 low to the high here. So we've only corrected 38.2 of that move, not 50%, just 38.2. So that is, we're still up toward the higher end of the 2-year, let's say, range for the euro versus U.S. dollar. So that is that suggests that there's possibly some further downside. I personally think that we can go down and test this level at 131.04, and we can go down to the 50% retracement at 130.16, and it's still at the upper half of where the euro's traded over the last 2 years. That would not surprise me. The idea, however, needs to be sort of supported by the technicals, and one of the things off this daily chart is we need to stay now below the old low going back to November and this broken trend line, which comes in around the, let's call it the 133 level. So currently trading at 132. 59. We just went down to 47 and bounced off of that support level. But we probably want to see the market stay below 133 tonight. So keep that level in mind in trading here tonight, as long as the price remains below the 133 level. That's more bearish for the pair. If you don't want to risk all the way up to the 133 level, take a look at the 38.2 to 50% retracement, maybe as the 100-bar moving average on the 5-minute chart comes down to this level. This is the 5-minute chart and the trend to the downside in trading here today. I take the high correction price during the New York session right here at 132.96, which is where our resistance level is, by the way, off the daily chart, and we go down to the bottom here. And a interim level that you probably don't want to see is near the 50% retracement, which also corresponds near the low, the original low from the day. Probably don't want to see the price move above this level, around the 70 to 75 level. So that's closer resistance. This is the other resistance area around the 133 level. We don't want to see the price move below or move above. Okay, so those are our risk levels. If it stays below those levels, the bears remain in control. Let's take a look at the pound versus U.S. dollar. On the move to the upside on the Bank of England Monetary Policy Committee meeting results, the price moved right up to the 200-day moving average, right up to the 100-hour moving average. That's this blue line right here. And the market sold off of that level. We have been down here testing the low channel trend line, and it looks like we're going to be closing below that level around the 166.01 level, currently trading around the 93 level. So that's more bearish for the sterling versus US dollar. Certainly bearish in the fact that we held against the 100-hour moving average, held against the 200-day moving average, and rotated back to the downside and ended up the day lower, even though the meeting minutes said that the UK two members of the UK wanted to raise rates. What does that say to you? What it says to me is that you see this move all the way to the upside from the 2013 low to the high here. We've only corrected this amount of it. Here's a 38.2 of it. It says to me that even though the Monetary Policy Committee meeting players are a little bit more hawkish, the pound sterling has already priced a lot of that hawkishness in this amount. And so there's room to roam as long as the price remains below the 200-day moving average. And if the price can remain below this trend line around the 166 level, that's even better. We should see lower levels. We could see the price move eventually down to 164.58. And I wouldn't be surprised to see 162.81 as long as the price remains below the 200-day moving average, okay? Notice that caveat. That's the risk. That's the risk right here. 200-day moving average, 100-hour moving average. So understand that dynamic. Shorter term, probably don't want to see the price move above the 12 to 20 level. That's the 38.2 to 50% of this rotation to the downside during the New York session. 166.20, not a level that we probably want to see to move above. If it goes above that level, we're still looking for sellers higher. But, it muddies the water a little bit in the shorter term. Take a look at the dollar versus yen. This pair moved away from this after breaking above this trend line. See this trend line right here, connecting the highs, high, 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 broke above the level, broke above the 50% of the year's trading range, 50% right here, and shot up all the way to the top side of this trend line. This level comes in at around the 70, 68, 70 level. Currently trading, we're at 73, so we're just above that level. Next target on the top side becomes 104.12. If I were to put a longer term view on the dollar versus yen, I would say this breakout of this area right here and the 50% retracement level, my longer term line in the sand is don't go below the 103.07 level, right? Don't go back below the 50% of the year's trading range. No, no, no. We held it here and came down. We held it here and came down. We cannot go back below that 103.07 level and expect that the market is going to trade higher from that. It would trade lower if we go below that level. So we want to stay above that level, chief and foremost. If we can move high, so the bulls, if you're long the dollar versus yen, look for continued upside to the upside as long as the price remains above that 103.07 level. For those people who don't want to risk that much on that trade, and I don't blame you if you don't want to risk that much, because I don't, you can put a fib, go to the 5-minute chart. This is the trend move today. Notice here how the market held held the 100 and 200 here, held the 100 and 200 here, came up here, went below the trend line, went below the 100 bar moving average, but came down to a retracement level, bounced back above the 100. Notice how he started to find support against the 100 and moved higher again here. So the 100 is starting to come up here toward the 50% retracement level. We'll get there in a few hours, and that will be our line, a closer line than the sand. Instead of the 103.7 level, which is don't want to see the price move back below that level, whatever it takes. This is a closer support level around the 51 to 59 level. Stay above that level, above the 100 bar moving average, and I think that's keeps the bulls in charge there for the dollar versus yen. Let's take a look at the Aussie versus US dollar. This had an up and down day. Those people who were with me last night during the Reserve Bank of Australia's Stevens' testimony, we saw the market initially move below the 200-hour moving average, and we saw support against the 200-hour moving average. Couldn't get below that 50% retracement level with any momentum. And then we saw the market move back up to the 100-hour moving average. So we did our lap here. We went to the downside, tested the 50%, moved up to the upside, tested the 100. In the London or late Asian session, early London session, we started to fall below the 200-hour moving average and looked more bearish until New York and London took it up here. And then where do we find resistance? Just a little bit above the 100-hour moving average before the market rotated back down to the downside. So we went a little bit above the 100-hour moving average, and we went a little bit below the trend line here. So there's a little wiggle room there for traders. But right now, you see this 200-hour moving average. You probably don't want to go above that level, right? Don't want to go above that level. We want to stay below that level. As we stay below that level and then get below this level right here, we're more bearish. So those people who are short from up here or through here, you have your stop in place. Don't trade above the 200. Stay below that level, and I think everything is okay. New Zealand versus US dollar continuing to come under pressure on the weekly chart. We fell below this trend line here. That's significant, isn't it? Also, yesterday we fell below the 200-hour moving average, and today we fell below this double bottom here. We had a bottom here in the month of June. We had a bottom here in the month of August. We held support here, held support here, moved higher, moved up, down through that level and trading here today. And now the 84.07 level becomes the line in the sand, right? The new line in the sand for the New Zealand versus US dollar. I don't want to see the price move above the 84 to 84.07 level, this area right here. If it goes above that level, then all bets are off for the New Zealand versus US dollar to the downside. But right now, the bears are in control, and the buyers are feeling the pain, feeling the nervousness from this currency pair. Finally, I'll take a look. I'll take a look at two more. Gold. Why is gold important? You see the 200-day moving average. You see the 50%. This is of the move up from almost the year low. This is at the end of December. This is the high price that we saw in March. The midpoint comes in at 1287.19. The 200-day moving average comes in at 1284. We came right down to the 50% retracement, and we bounced back up. We are below the 100-day moving average at 1296. So stay below 1300, let's say, and then move below 1284. And this should trigger stops on a move below the 200-day moving average and the 50% retracement. A move below this area is more bearish for the gold. So keep that level in mind. The final currency pair I want to take a look at for you before I close it up is the sterling versus yen. This is on a daily chart. And what do you notice here with the 100-day moving average, the blue line of the chart, the 200-day moving average, the green line of the chart, is that the market's been ping-ponging back and forth between each of those key levels. The 100-day moving average is at 172.28, and that's about where we peaked out today in trading. It wasn't but yesterday we were down at the 200-day moving average at 170.59. So we're looking for either a break to the upside, which we're right near right now, or a break to the downside, and that is going to be key for the next trade in the sterling versus yen. If you like this report and want to see more of them, a good way to do that is to go and subscribe to my YouTube channel. Another thing that you can do or should do is go to gregmikefx.com, put your name right here, and I will be happy to send you these videos in the mail, or your email. So you can come on my and learn other things about what I'm up to. So do that. Go to that website, and I'll be your mentor. So let's end it there. My name is Greg Michalowski, and from GregMikeFX.com. Good fortune with your trading. Bye-bye now.